Preparing for a finance manager at EDP interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Tell me about your experience and why you want to join EDP as a finance manager. I have built my career around turning financial data into practical decisions, including budgeting, forecasting, performance reporting, and process improvement. EDP appeals to me because energy combines long-term investment, operational complexity, regulation, and the transition toward renewables. I would bring disciplined analysis, strong control awareness, and a collaborative management style. My goal would be to help business leaders understand performance drivers, allocate capital effectively, and deliver reliable reporting while supporting EDP's strategic and sustainability objectives. While answering, connect your financial planning, reporting, controls, and leadership experience to EDP's energy business, emphasizing analytical judgment, stakeholder management, sustainability, and motivation for working in a complex international organization. Question 2. How would you build an annual budget for an energy business? I would start with operational drivers rather than simply extrapolating prior year costs. For an energy business, that means forecasting generation, availability, demand, energy prices, tariffs, fuel or purchase costs, headcount, maintenance, CapEx, and financing assumptions. I would involve operational owners, challenge their inputs, document key assumptions, and create downside and upside scenarios. After approval, I would establish monthly variance reviews so the budget remains a management tool rather than a static annual document. Make sure to cover operational drivers, generation and demand assumptions, energy prices, production volumes, OPEX, CapEx, financing costs, regulatory factors, ownership accountability, challenge processes, and monthly monitoring against approved targets. Question 3. What is your approach to forecasting cash flow? Reliable cash forecasting starts with separating recurring operating cash flows from timing-sensitive items. I would forecast collections, supplier payments, payroll, taxes, maintenance, CapEx, interest, debt maturities, and dividends, then layer in sensitivities for prices, production, and working capital. I would maintain a rolling forecast, compare actual cash movements with prior estimates, and investigate recurring bias. Finally, I would present liquidity headroom and funding needs clearly to Treasury and senior management. In your answer, talk about operating cash generation, working capital, CapEx timing, debt service, taxes, dividends, hedging, liquidity headroom, forecast frequency, ownership, and reconciliation between cash forecasts and accounting information. Question 4. How would you analyze a significant budget variance? I first validate the data and define the variance against the correct baseline. Then I decompose it into price, volume, mix, timing, foreign exchange, efficiency, and one-off effects. For example, lower renewable generation may reflect weather rather than poor operational performance, while higher maintenance could be timing-related or structural. I would discuss root causes with the business owner, update the forecast if necessary, and agree actions, deadlines, and accountability rather than merely explaining the number. Be sure to mention quantifying the variance, separating price, volume, mix, timing, and one-off effects, identifying controllable versus uncontrollable causes, assigning ownership, evaluating forecast impact, and recommending corrective action. Question 5. Which KPIs would you monitor for EDP's finance and business performance? I would use a balanced set of financial and operational indicators. Financial measures could include revenue, EBITDA, operating cash flow, free cash flow, net debt, leverage, CapEx, and return on invested capital. Operational measures should explain those results, such as generation, availability, load factors, customer volumes, and cost per unit. I would also include safety and sustainability metrics because they influence long-term value. The dashboard should highlight trends, thresholds, and actions, not overwhelm users with data. Focus on a balanced dashboard covering revenue, EBITDA, cash flow, leverage, CapEx delivery, return on invested capital, generation or availability, working capital, safety, customer measures, and relevant sustainability indicators. Question 6. How do you evaluate a renewable energy investment? I would evaluate the project through an integrated operating and financial model. Key inputs include expected production, degradation, contracted or merchant power prices, CapEx, operating costs, useful life, taxes, financing structure, and decommissioning obligations. I would calculate NPV, IRR, payback, and coverage metrics, then test sensitivities for resource quality, delays, inflation, curtailment, and price downside. I would also assess permitting, counterparty, grid, and regulatory risks before recommending approval or renegotiation. In your answer, cover discounted cash flow, project life, production assumptions, power prices, contracts, operating costs, CapEx, financing, taxes, residual value, sensitivity analysis, regulatory risk, and return thresholds. Question 7. How would you assess a capital project that is over budget and behind schedule? I would establish the project baseline and compare budget, committed costs, actual spend, physical progress, and the estimate at completion. I would identify whether overruns arise from scope changes, procurement, labor, permitting, financing, or contractor performance. Next, I would quantify delay effects on revenue, interest, and returns, including the remaining contingency. If the revised economics no longer meet thresholds, I would present options such as redesign, renegotiation, staged investment, or stopping the project. Make sure to cover earned value, committed versus spent costs, remaining estimate, schedule slippage, change orders, contingency, contractor performance, financing effects, revised returns, escalation, and a clear escalation recommendation. Question 8. Which international financial reporting standards areas are particularly important for an energy company? Important areas include IAS 16 for generation and network assets, IAS 36 impairment, International Financial Reporting Standards 16 leases, International Financial Reporting Standards 15 revenue, International Financial Reporting Standards 9 financial instruments and hedging, International Financial Reporting Standards 10 consolidation, and IAS 37 provisions. Energy companies also face significant judgments around useful lives, decommissioning obligations, power contracts, and recoverable amounts. I would ensure accounting positions are documented, assumptions are evidence-based, controls operate consistently, and auditors and operational teams are engaged before close. Mention property, plant and equipment, impairment, leases, provisions, revenue, financial instruments, derivatives, consolidation, asset retirement obligations, and judgment areas requiring robust documentation and collaboration with auditors. Question 9. How would you test an asset for impairment? I would begin by identifying impairment indicators and confirming the appropriate cash-generating unit. Then I would prepare a recoverable amount analysis using value in use or fair value less costs of disposal, supported by approved forecasts. Critical assumptions include production, prices, operating costs, useful life, discount rates, and terminal growth. I would challenge management optimism, run sensitivity cases, reconcile the model to budgets, and document headroom and potential trigger points for future reassessment. Be sure to explain cash-generating units, impairment indicators, value in use, fair value less costs of disposal, forecasts, discount rates, terminal assumptions, sensitivities, headroom, and transparent documentation of judgments. Question 10. Describe how you would manage the month-end close. I would manage close through a clear calendar assigning owners, deadlines, dependencies, and review responsibilities. Key controls would cover revenue cutoff, accruals, provisions, fixed assets, leases, intercompany balances, reconciliations, and unusual journal entries. I would prioritize material risks, maintain an issues log, and escalate unresolved matters early. After each close, I would analyze late adjustments and recurring errors, then automate or redesign activities to improve both reporting quality and cycle time. Focus on a documented close calendar, materiality, reconciliations, accruals, estimates, intercompany balances, fixed assets, revenue cutoff, review controls, issue escalation, and post-close improvements to increase accuracy and speed. Question 11. How do you ensure strong financial controls? I begin with the risks that could materially misstate accounts, cause fraud, or breach policy. Controls should assign clear owners and include segregation of duties, approval thresholds, system access reviews, reconciliations, and documented evidence. I test whether controls operate consistently, not just whether they are designed well. For deficiencies, I assess severity, identify root cause, agree remediation dates, and track closure. Strong controls should protect the business without creating unnecessary manual bureaucracy. In your answer, discuss risk assessment, segregation of duties, authorization limits, reconciliations, access controls, evidence standards, monitoring, remediation, control ownership, and balancing prevention with efficient business processes. Question 12. How would you manage working capital in an energy business? I would manage working capital by linking balances to operational and contractual drivers. For receivables, I would monitor billing accuracy, aging, disputes, collections, and customer credit risk. For payables, I would preserve supplier relationships while using agreed terms effectively. I would also consider inventory, collateral, margin calls, and settlement timing in energy markets. A weekly or monthly dashboard should identify cash opportunities, risks, accountable owners, and the effect on liquidity and borrowing needs. Cover receivables, payables, inventory, collateral and margin requirements, contract terms, billing accuracy, collection behavior, supplier relationships, cash conversion, operational constraints, and coordination with commercial and treasury teams. Question 13. What role does treasury play in a large energy company, and how would you work with it? Treasury protects liquidity and manages funding, market risk, banking relationships, and financial flexibility. I would support Treasury with accurate cash forecasts, CapEx schedules, debt service information, covenant calculations, and timely visibility of risks. I would also coordinate on interest rate and foreign exchange exposures, ensuring accounting treatment matches approved hedging strategies. The relationship should be proactive. Finance explains business drivers, Treasury translates them into funding actions, and both teams monitor headroom under stressed scenarios. Make sure to mention liquidity, funding, debt maturity, interest and foreign exchange risk, hedging, cash pooling, covenant compliance, bank relationships, forecast quality, and timely communication between finance and Treasury. Question 14. How would you explain a complex financial issue to a non-finance executive? I would begin with the business question and the decision required, not with accounting terminology. For example, I might explain that a project delay reduces expected cash generation and increases financing costs, then quantify the impact and show the available choices. I would distinguish verified facts from assumptions, use a concise chart where helpful, and explain risks in practical terms. I would finish with a clear recommendation, decision owner, and next steps. Focus on starting with the decision required, using plain language, separating facts from assumptions, quantifying business impact, limiting technical detail, presenting alternatives, and confirming the audience understands the recommendation. Question 15. Tell me about a time you improved a finance process. In one role, the monthly reporting pack required several manual spreadsheet consolidations and regularly produced late adjustments. I mapped the process, removed duplicate reviews, standardized data definitions, and introduced controlled templates with automated validation checks. Reporting became 2 days faster, errors declined, and management received consistent variance analysis earlier in the month. I also documented ownership and exception procedures, so the improvement was sustainable rather than dependent on one experienced analyst. Be sure to structure the example around the original problem: root cause analysis, redesign, automation or standardization, stakeholder involvement, measurable benefits, control improvements, and lessons learned. Question 16. How would you handle disagreement with a business leader over a forecast assumption? I would first understand why the leader supports the assumption and what operational evidence informs it. Then I would compare it with historical performance, external data, contractual information, and independent sensitivities. Rather than arguing over one number, I would show the financial effect of base, upside, and downside cases. If disagreement remained, I would document both views and escalate through the agreed governance process. My aim is transparent decision-making, not winning the debate. In your answer, emphasize listening first, clarifying incentives, using evidence and independent benchmarks, presenting scenarios, documenting assumptions, escalating objectively, and preserving a constructive relationship after the decision. Question 17. How do you approach scenario analysis and stress testing? I would start with the risks most capable of changing earnings, cash flow, or leverage, such as power prices, lower production, delays, inflation, rates, or regulatory changes. Each scenario should alter connected drivers consistently rather than applying arbitrary percentages. I would quantify impacts on EBITDA, free cash flow, liquidity, covenants, and project returns, then identify mitigations. I would present a limited number of decision-useful scenarios and refresh them when market conditions change. Mention selecting material risks, defining coherent scenarios, changing operational and financial drivers together, assessing liquidity and covenant effects, identifying mitigations, avoiding false precision, and converting results into management actions. Question 18. How would you manage an audit request or an accounting judgment under challenge? I would clarify the precise accounting question, materiality, and requested evidence before responding. I would gather relevant contracts, operational data, standards, prior conclusions, and comparable treatments, then document the alternatives and key judgments. For complex matters, I would involve technical accounting colleagues and communicate with the auditors early rather than at the deadline. The final position should be principled, consistently applied, and supported by an audit trail that explains both the conclusion and the sensitivity. Focus on defining the issue, gathering authoritative guidance and evidence, documenting alternatives, involving technical specialists, maintaining an audit trail, communicating early, and making a balanced, defensible conclusion. Question 19. How would you lead and develop a finance team? I would set clear priorities, define ownership, and connect each person's work to business outcomes. I like regular one-to-ones, practical coaching, and objectives that combine technical quality with stakeholder service and process improvement. I would delegate meaningful responsibility while retaining appropriate review controls, and create backup coverage for critical activities. During demanding closes, I would manage workload transparently and recognize strong performance. My goal is a team that is accurate, resilient, curious, and increasingly independent. Be sure to discuss role clarity, coaching, measurable objectives, technical development, delegation, succession planning, psychological safety, feedback, workload management, and maintaining high standards during reporting deadlines. Question 20. What would be your priorities during your first 90 days at EDP? My first priority would be listening, meeting finance, operations, treasury, controlling, tax, audit, and key business stakeholders to understand expectations and pain points. I would review the reporting calendar, key KPIs, forecasts, major projects, controls, systems, and open audit matters. I would then identify a few practical quick wins, such as improving variance commentary or close ownership, without disrupting critical processes. By day 90, I would present a prioritized roadmap with owners, benefits, risks, and milestones. In your answer, cover listening and stakeholder mapping, understanding strategy and reporting, reviewing controls and risks, learning systems and data flows, identifying quick wins, respecting existing knowledge, and setting a structured improvement roadmap. If you are still with us, congratulations. You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.